Let's talk now about Daniel Kahneman, very important thinker in finance. He's the one who wrote the book Thinking Fast and Slow. He's a Nobel Prize winner in economics, one of the founders of behavioral economics. He and Tversky are well recognized as challenging conventional thought and rational thinking and rational decision making, um, along with Richard Thaler, big players in behavior economics, behavioral finance. I've heard some podcasts that are somewhat negative on behavioral economics. I think Asness and some of the other big thinkers as well say it really doesn't have the ability to create trades or any kind of model that you can set up. So it's still somewhat of a concept more than an actual something that you can implement. But it's an interesting idea. Certainly is having huge influence on how people think about risk, especially when we get into Annie Duke and her book Thinking in Bets. It's heavily influenced by Kahneman. So I'd encourage you to read his book or watch these videos. We'll talk through some of those videos and some of his thoughts. I want to walk you through some of his main arguments. A few of these are a little tricky. The one thing you'll notice, especially in his Nobel Prize speech, is he shows, I have some of the charts from that speech, and I tried to fix the ones that were in error. He had some charts that had errors on them, and he would actually mention that, and it's like he was surprised. I mean, this is someone who's making his speech for the Nobel Prize win, and he's got errors on his slides. So it's a little frustrating, and some of them are difficult to understand even without the errors, and you throw the error in there and it's really hard to follow. So I'll do my best. I'm not saying I want you to fully understand all of the tests that he did. Some of his tests are a little esoteric. There was an Economist article just recently that I might show you in the next session to show some of the questions that he asked and how he showed that humans really are not perfectly rational decision makers. And that gets you to this first concept of bounded rationality. So we're going to talk about bounded rationality, and then his most famous theory, which is prospect theory. We'll talk about experience versus memory, and we'll talk about how Taleb actually addresses that as well. So those are the three I want to hit on. So bounded rationality is the idea that humans were rational, but we're limited in our decision making because of the complexity of our decisions. There's cognitive limitations to how we think, and there's time limits to make a decision. We can't make a full, deep thinking decision about everything because otherwise we'd never get anything done. And so what we do instead is we're satisficers. We don't say, I want the best answer. I just want an answer that's good enough given the limited time I need. We're seeking satisfactory solutions, not necessarily an optimal solution. So we do things that financial theory and economic theory says that doesn't make sense. No one would ever do that. But given our constraints, given our biases too, and that's what he's thinking about with thinking fast and slow. Our fast thinking is our intuition. Our intuition is heavily influenced by biases. It's very much distorted by what he talks about prospect theory, very much distorted by memory. Those are the two things we're going to talk about next, prospect theory and memory, how we view risk and how we remember things. That's our fast thinking. It's our intuitive thinking. It's what we use most of the time. And then there's the slow thinking, which is our analytical, very rationally consistent thinking. With fast thinking, we commit many systematic biases and errors that lead to bad decisions, but at least we get things done. We don't spend 40 hours deciding whether we're going to have pizza or hamburgers for lunch. So we've got to make decisions, we've got to move. So usually it doesn't hurt us, but there are times where fast thinking at the wrong type of decision can actually do tremendous harm. And that's where he wants to address it. Annie Duke does a good job of taking that and says, how can we fix that? How can we do better? I showed you the article by Kahneman earlier on how to bring in more people to try to control some of these biases. But some of the things he mentions that are, I think you'll agree this is the way the mind thinks. One is economics is set up that we make decisions based on our states, where we are. But a lot of times we make decisions based on changes in our states rather than their actual states itself. So let's, it's an example that I think most people know exactly where I'm going with this. Let's say Susie had $100,000 the first year. She invested it. At the end of the year, she had $105,000. At the end of the second year, she had $110,000. Mike invested $100,000. At the end of the first year, he had $450,000. At the end of the second year, he had $125,000. So you ask, who is happier at the end of the second year, Mike or Susie? Well, most people say, well, Susie's happier. But who should be happier? Well, economics says, well, Mike should be happier. If I told you at the beginning, you have a choice of investing $100,000 and you either have at the end of 2 years $110,000, $125,000, which would you pick? Obviously, you would pick to be in Mike's position. Mike should be happier. He's better off. But Mike's thinking about the change in his state. He had 450. Now he only has 125. He's upset because of that change in his state. Whereas economics is set up that our utility, what drives our decisions, is actually the state itself and not the change in the state. Well, that's pretty big, because if we're making decisions that Susie's better off than Mike, then we're making bad decisions, because obviously Mike is better off than Susie. Framing's a big one. Boy, he's done some interesting tests on this. But just, and I'll show you a framing question from the Economist article here. Actually, I might do it. I might put this on pause and show it to you because I think it's an important one. So let me get through what framing means. But just the way the question is stated will radically change how people make their decision. Richard Thaler has a book called Nudge, N-U-D-G-E. Wasn't my favorite book. I'm not a huge fan of Thaler's writing, although he's an extremely important thinker in this area. But in Nudge, he talks about governments wording things in a way that you get the decision you want. And there's a lot of applications of that. Thaler has actually been used. He was pretty heavy in the previous presidential administration, and how to do government policy in a way that you don't force people to do things, but how you word it, how you present it to them, you get them to do what you want anyway, just by the framing of the question. So staging things framing things in terms of states, in terms of gains or losses, you get very different answers. Let me put this on pause and I'll find that Economist article, and I think you'll see what. So here is the Economist article. It's on it's on their books and arts, talking about how we use language. So it fits very well in the framing. So here's the framing one. This is a really famous from Kahneman. So you have two choices. You have a disease that is expected to kill 600 people. So your two alternatives. Option A, 200 people will be saved. If you do B, there is a 1/3 probability that 600 people will be saved, and a 2/3 probability that none will be. Which would you choose? So here they say 200 will be saved, and here's a 1/3 probability that 600 will be saved, 2/3 probability that none will be saved. Which do you choose? And then here's another set of options. In one, 400 people will die, or you can do D. There's a 1/3 probability that no one will die, and a 2/3 probability that 600 people will. Now, if you look at these, most people will pick, they'll pick option A here, and they'll pick option D here. And why is that? Well, if you look at them, so most people choose A in the first scenario and D in the second scenario. A said what? That 200 people will be saved. You notice it's in positive terms. It's framed in terms of positive. Whereas B says there's a 2/3 probability that none will be saved. That sounds pretty dire. And so here you get C, 400 people will die. Well, that's exactly the same as A, isn't it? You have 600 people and 200 will live. Well, that means 400 will die. So A and C are exactly the same. And D is there's a 1/3 probability that no one will die, and a 2/3 probability that 600 will. Again, just framed differently. and they're exactly the same. D is exactly the same as B, and A is the exact same as C. And yet, when you look at it, the majority of people will choose A in the first scenario, and a majority of people choose D in the second scenario. And he does this in Thinking Fast and Slow. And it's very overwhelming. It's not like it's 51% and 49. So this was something he did, some time ago, but it still works today. It's something you could actually test yourself and see. So that is the framing aspect of that just by changing the words. So saying 200 people will live versus 400 people will die, just that radically changes what people select, even though when you look at the two choices, they're exactly the same. So that's framing. Mental accounting, we tend to segregate pools of money when there's really no reason to segregate them. I'm hoping at the end of the semester we can talk about that. I call it the personal balance sheet, looking at your risk from a holistic standpoint, an integrated standpoint. But most people don't do that. They separate out money in ways that make no sense, and then they end up making very suboptimal decisions. There's availability heuristic, that we're more sensitive to a prospective loss than a more probable one, just because we can imagine it more easily. I mean, a good example is some people, they've done this pricing where they'll price airplane insurance. So life insurance, if you die in a plane crash, and they'll say, how much would you pay for that? So people would put a price down on that. And then they'll say, we have airplane life insurance if you die in an airplane due to a terrorist attack. Well, the first one covers everything, including terrorist attacks. The second one only covers you in the case of a terrorist attack. And yet studies have shown people are willing to pay more for the second one. Why? Because after 9/11 and after hearing about previous planes that have crashed due to terrorist events, or at least that have been hijacked, they can visualize that more. It makes more sense to them. And because of that, we don't have very many plane crashes, but 9/11 is very much on our minds. And so people are actually willing to pay more for an insurance that covers less than an insurance that covers more, including the thing that the second one covers. You have hyperbolic discounting, which means if you go out too far into the future, people discount these things so high. This might be the problem with the retirement crisis. Retirement's 30, 40 years away, and people aren't really worried about that now. So they'll do things today that really don't make any sense at all. They really should be saving for retirement. It's a risk that's going to hit them. It's going to be big. It's going to have a huge impact on their lives. And yet they don't do anything because their discount rate is too high. That's what some people argue why issues like global warming and other things are so difficult to deal with. We'll talk a little bit more about that here later. Here I have some comments to talk about COVID-19 and global warming. But it's really hard in a capitalistic society when we view things on a discounted basis, and when we're looking at doing things that are 50, 100 years away where we may not be alive, we tend not to be too concerned about those and don't do things we probably should do. Some of these get a little esoteric. We're better with averages than with sums. He gives some examples here. Averages are easier to do, so we tend to use averages, but many times sums is what we should be doing. Averages are intuitive. Sums, we have to sit down. So if I give you 7 numbers, you can probably guess the average faster. You can add them all up, especially if they're longer numbers. So here he has a few examples here. I won't go through all of them, but one of them is evaluating a set of goods. And here he does it here. So you have these two sets. You have a small set and a large set. The small set has 24 pieces. They're all in good condition. None are broken. Here you have a larger piece, 40 pieces, and 2 of them are broken. So let's see. This his PowerPoint got a little out of place, but essentially what it says is the larger set had some broken pieces in it, but the broken pieces, if you took them out, you still had a whole lot more dishes than you had in set A. So you should be willing. It makes no sense to pay more for set A than set B because set B has more pieces. It's true a few of the pieces got broken, but you still have more pieces in B than you do in A. And yet people would price A as more valuable than B. And why was it? Because they were looking at the average value of the pieces, whereas A, they were all in good condition. Whereas B, when you look at the average, there were some that were broken, so the average was less. Where what they should have been doing is summing. They should have said, how many pieces do I get in B? How many do I get in A? So I should be willing to pay more for B. But that's the evaluation of a set of good. Evaluating a set of observations. This one's a little trickier. I'll let you read it on your own or listen to his video. It's a little bit trickier to get through the math on this, but it has, again, with how we use averages versus sums and how we make bad statistics, especially with the sample size. Small samples give us higher confidence, and that doesn't really make sense. So what's the implication of this? We have confidence in a hypothesis largely determined by the proportion of evidence supporting it. We're insensitive to the reliability of evidence. We jump to conclusions when evidence is scant. We have unjustified doubts when samples are large. It's amazing we do exactly the opposite of what we should do. And there's a weak correlation between our accuracy and how confident we are. And so he has shown this over and over again. Here with these two, with evaluation observations, you can look through these two and see what he's saying here. But it's a little tricky. I don't want to get into it too much. A third way averages and sums doesn't work is how we look at an individual, whether they belong to a category or to a group. So Linda is 31 years old. She's single, outspoken, very bright. She's majored in philosophy. As a student, she was deeply concerned with issues of discrimination and social justice, and also participated in anti-nuclear demonstrations. What are the probabilities that Linda is a bank teller and an active feminist, or that Linda is a bank teller? And people will pick this one, the first one. She's a bank teller and an active feminist, more than she'll pick the second one. Well, obviously, the second one is far more likely because it includes all bank tellers. But that gets back to my, talking about insuring a terrorist event versus insuring everything. So it doesn't make sense. Episode, we'll talk about the episode versus a set of moments. We'll talk about that when we talk about how we understand our memories and our history and how we look at that. But it's an interesting. So we will get back to this one. It's pretty amazing, in medicine, assessing pain. If the pain is greater, well, I'll go ahead and go through this because I'll get back to it again when we talk about memory. But so patient A is having this procedure, and his worst pain is less than B, and his total pain lasts shorter than B. So A, his highest pain is a little bit lower than B's. He has less pain, and it lasts a lot shorter. But B, his average pain is lower than A's, even though it lasts longer. And the other thing that's really, really important is A's biggest pain happened right at the end, or B's smallest pain happened right at the end. So you ask these people, which of these people would be willing to go through this procedure again? You would think it'd be A, because the total pain is a lot less, the time of the pain is a lot less, the worst pain is slightly less, but not much. But most people that are in A's situation would say, I don't want to ever do that again. People in B are more likely to say they're willing to go through the procedure again, even though they suffered more. And that has to do with the average pain, but also with the moments. The last moment was less painful for B. The last moment was more painful for A. That's how this gets into averages versus sums. B's sum was greater, but A's average was higher. But it also comes in with memory. We tend to remember the last episode more, and that's why B is more likely to do the procedure again than A. So you can see Kahneman is testing things that there's an obvious rational answer, and yet most people pick the irrational solution, pick the least rational of the two choices, and that has to do with the way we perceive time, the way we look at averages versus sums. It's the way things are framed. It's what our mind can remember and think of and visualize. So that's a big part of his theory. Bigger part of his theory is prospect theory. And I want to get into this because there are serious implications for you as a finance major or an actuarial science major for prospect theory.